With the rising costs of living, inflation and interest rates, debt management has become an extremely important consideration the last few years. Debt can be both good and bad, and how we determine this is by considering whether the money's been borrowed to buy an asset or a material good. And if it is an asset, is that asset income producing or 100% capital growth strategy? The next consideration is the cost of debt. The cost of debt is basically the interest payable. Loans that are higher risk for the lender will have a higher rate. And risks can be based on the borrower's debt levels or income, or if the loan is asset-backed or not. The plan we've all heard over the years is to eliminate bad debt, but how do we really do this? Well, we can start with developing a budget to see if we can find some additional repayment dollars that can be used to reduce debt. We can also look to consolidate to a lower rate a loan facility and also develop a repayment plan. Only when the loan is repaid can we start to grow your wealth. Let's now look at good debt. What are good debts? Good debt would include your mortgage as it's backed by your home, or an investment loan that's invested in an income-producing property or shares. These loans are backed by assets that grow in value, and the investment loan interest is therefore tax-deductible in most cases. But beware, we don't want to borrow $1 to save 50 cents. It must be a good asset. Let's consider a mortgage. What's the best way to manage a mortgage? The mortgage is a good debt as it's asset-backed, and the value of the home will rise over the medium to the long term. However, interest is non-tax deductible as the home is not income-producing. You're living in it. So it's not a tax-efficient structure. So we want to pay down our mortgage as soon as possible. An investment loan, on the other hand, is also a good debt as it's asset-backed, but as the asset is income-producing, the interest can be tax-deductible. It's best not to pay off this type of debt until we're selling the asset, as it allows you to leverage into other assets using the capital repayment to pay interest on other loans against other assets. But remember, this is subject to cash flow and serviceability. Now, as interest rates have increased over the recent years, costs of debt have risen, and this is leading to higher repayments. This is the cash flow risk of accumulating debt. Higher interest rates will equal larger tax deductions on investment debt. However, this is not the case for a mortgage. The key is only to take on debt that you can afford at these higher rates, because it can be disastrous to sell an asset in a high interest rate environment due to an affordability issue. One such strategy many of our clients employ to reduce the mortgage, manage tax and build wealth is a mortgage recycling strategy. In this scenario, we borrow against the home to invest in an income-producing asset. As the asset is income-producing, interest is usually tax-deductible. The income from the asset can be recycled back into additional mortgage or non-tax-deductible interest loan repayments, and an investor can borrow and invest more based on the amount that's paid off the mortgage. Over time, the non-deductible mortgage will reduce in value, and the investment loan that is tax-deductible plus the asset that is backing it will increase in value. How can Manly Financial Services help you? We can help if you're having problems with your budget, repaying short-term, bad, high-interest rate debt. We can help if you'd like to buy a home or investment property and would like help on structuring your asset effectively for tax and investment purposes. And we can also help if you'd like a plan to eliminate your mortgage and grow your wealth over the medium to long term. Contact us via our website at manlyfs.com.au or reaching out via email or our office number. And if you found this video informative, please like and subscribe and comment on the best ways you found to reduce debt over time. Take care.